Welcome back, everyone, to Money and Markets. We have given you a snapshot of where the U.S. economy stands right now, but how do top money managers see the economy and how is it affecting their investment strategy? Joining us with those answers is Sebastian Leburn, Chief Investment Officer of Weiss Capital Management, and John Browne, the Senior Market Strategist at Euro Pacific Capital. It is always good to see both of you. Thank you so much for being here. John, I want to start with you first. What is your take on the health of the U.S. economy right now, and where are we going come 2011?
Well, I think we're teetering along, and some consumers are beginning to feel more confident, very tentatively. But the real key to healthy growth, as opposed to inflationary growth, are jobs, which create higher net disposable income and then consumer demand, and therefore production and employment. The key is jobs, and in America, we're still shedding jobs now, 17% unemployment, which is officially disguised as 9.8%. But it's a bad situation in Europe. Now, the policy of the governments are very different. In the European Union, which is 650 million people, they've decided to go for austerity, to face the music and bite the bullet and accept a certain amount of deflation. But, of course, it's now getting out of hand because that, in a way, triggered their debt problem. And so they've now got real problems and are thinking of, well, they're in a panic, in fact, of what to do, but it means austerity. In America, the Federal Reserve and the government decided no austerity, just keep inflating. But of course, that's a high road to nowhere, really. And I think the individual consumers in America are realizing this and are still hoarding cash. So the outlook for me is austerity in Europe and in the United States. And that spills over to the healthy side of the world economy, which are the tigers in the Far East and the resource economies such as Australia, Canada, Brazil, and things like that, because they rely on exports to the producers in India and China, who then rely on exports to Europe and America. And if those exports falter, the whole chain comes unwind. So I think there's a severe risk in 2011 that the reality of the la-la land we've been living on in false amounts of cash is coming to an end.
All right, Sebastian, do you agree? This day of reckoning here?
Yeah, I think John's spot on the jobs. Okay, we just had the November unemployment report Friday. U.S. produced some 40,000 jobs. I mean, it was anemic. It'll probably be revised up next month, but still we need about 200,000 jobs in this country just to keep the unemployment rate steady. Forget about bringing it down. So the jobs is what we need, and we're not getting that. So we see that too. We see maybe 2% growth in the U.S., maybe a little bit less in Europe. But I would say that I think Europe and the ECB and the European Central Bank is going to take the direction the Fed did. I think they're going to start the quantitative ease, which is going to be negative for the euro, maybe a little bit less austerity talk because the market really hates the austerity, as you can see with the Irish bonds and Portugal, and now Spain, and now Italy. So it's a big problem. It is going to fuel the seeds of a bubble in Asia, which is all the money's going there from all of our liquidity pumping that we're doing. So it's two different worlds, right? I mean, we've got the developed economies growing very weakly, very weak, and we've got Asia booming. So how do you prepare for that? And investors have to be willing to accept a lot more international exposure in their portfolios than they otherwise used to be.
Well, let's talk specifically about that. You're both painting a picture of two different economic worlds here. Where should investors put their money? What asset classes are out there that they should be playing? John?
Well, I personally believe in these very uncertain times that continue to be extremely uncertain, that a heavy allocation to precious metals, gold and silver in particular, is going to make people sleep at night. I've had my people very, very high. I think maybe they could come back a little, but still at least 50% in my opinion. And then into raw materials, raw material producers, stocks of raw materials, and foodstuffs, things that people need even if there's a crash. They're going to need food and they're going to need some form of raw material. And I think the stocks to avoid are things like real estate, which is, in my view, still speculative in Europe and America, and consumer products, and financials that have still got enormous amount of toxic assets stashed away. And there are problems ahead for European banks. I mean, this rescue of Ireland, it's not to save the Irish people at all. It's to save the banks.
The banks, of course.
And the whole thing. And gradually people are going to see this. And therefore, when Sebastian says quantitative easing, I totally agree with him. But the appetite of the politician for quantitative easing in the United States and in Europe is beginning to shrink the more people see it as a complete charade.
Well, that's true.
And when this charade ends, I think there's going to be tough times ahead. And to me, that's what you should look at. For the really adventurous, I think stocks in the tiger countries, in the raw material countries, India, China, and things like that, are still growing fast. Risk that on the short term, but be quick to get out once the real recession starts or deflation starts.
your place?
That's right. Well, you need to have a disciplined strategy, whatever it is. I mean, you can buy the more emerging markets, which we like as well. We have a secular income theme in our firm. You know, we've got different clients with different objectives. Okay, so our focus is on finding investments that have secular income. Okay, so that includes bonds. That could also include dividend-paying equities. Some. You know, you can get Johnson & Johnson and Cisco Foods. You're yielding 3.5%, right? So you got treasuries barely giving you 3%. So, you know, you got to have an income focus. You need something that's going to pay you a current return via dividends. And then the capital appreciation will come at some point. But I think to John's point, you got to, there's speculative investments you can buy with some part of your portfolio, but you have to have an exit strategy with that. We also like precious metals. Commodities make sense, especially with all the liquidity and the quantitative easing that's going on. We're not as heavy as John would be as to 40 or 50%, which I'm sure that's worked very well. But we wouldn't be surprised to get a pullback in gold, at least maybe in the next couple of weeks or maybe right after the turn of the year. And then we'd like to be further increase our exposure there as well. Because when you've got, I'm sure John will tell you, when you've got short-term interest rates so low or at zero, the opportunity cost of holding gold and silver is very low. So it's almost acting as its own reserve currency, if you will.
Let's talk stock market. Go ahead, John.
I'd just like to add to what Sebastian said, one thing for investments, and I hear it time and again from people that I advise, and that is, oh, I've got to have my income. I think it is the only time you ever have to think of a difference between income and capital gain is for tax purposes. For an investor, you should always be looking at total return.
That's right.
Because say you invested in silver 16 months ago, you've now doubled your money. And so if you've had no income from that, you just take a slice off the top. You're still ahead 80% if you took a 20% cut in there to provide income and to pay your bills. And so you should always be concentrating on total return.
Sebastian, give me some individual names here, places to go, places to avoid.
Well, I think, getting back to we have a general theme on income, okay, on having the cash flow there. We have, some of our clients are in their latter stages of their investment cycle, so we can't load them up into securities that are very volatile because they can't do that. You know, they can't sleep at night with that. So we have a core and explore type of framework where we have a core assets that are in fixed income, corporate bonds, maybe intermediate term, not high duration, because we know interest rates are eventually going to go up unless we become Japan, which is the story for another show. But so individual names in the U.S., some large cap dividend paying stocks, as I mentioned, Johnson & Johnson, Cisco. Right. I mean, these guys are paying 3.5%. Not very sexy, but at least you're getting something until the price at some point comes in your favor.
What about names to avoid?
Financials, we can't touch that right now. As I think John mentioned it earlier, the housing market, if we do get another double dip, which we think could happen next year, you've got these companies that are saddled with bad debts on their books that are going to take years to work through, and it's just going to be horrendous for these guys for at least another 5 or 10 years. We just can't touch them right now. So financials we would avoid, real estate as well to some degree. But ultimately you have to have an exit strategy with whatever you buy. I don't care if it's gold, if it's treasury bills. You got to have something that'll get you out if things get bad. And a lot of people didn't do that, particularly in 2008, right? So you got to have an exit strategy when you have a low growth economy that could teeter into a recession next year.
All right, New Year's around the corner, your New Year's Eve resolution of sorts here. Somebody walks into your office, they have their money, they put it on the table. What is your advice going to be come 2011?
My New Year's resolution for myself and anyone I advise is don't be tempted into yield, to grasp for high yield or high returns on a current basis. Go for long-term capital gains, which is why I favor precious metals, for example. I don't care that there's no yield. There may be even a negative yield for holding costs and things like that. But I personally think 2011 is that reality is going to start to dawn, not only on politicians, which is just beginning now in Europe where they're panicking about their bonds and so on, and in America where people are not supporting QE2 as they thought they would, but to consumers. People are going to suddenly realize these central banks and these politicians have not got anything under control at all, and we're really in a bus careering downhill, and some have still got the foot on the accelerator.
Sebastian, last word to you.
That's right. I mean, the power is moving from the west to the east, right? We're going from Europe is a mess, the U.S. is close behind. So you have to have more international exposure in your portfolios than you otherwise would be comfortable with. The nice thing about the products now is that there's ETFs, for example, that you can buy that have a dividend focus, which again we like. That's not just a U.S. story; it's an international story. So we see a lot of volatility. So you have to be very active. But we get a pullback sometime early next year, and you add to the commodity space, in our opinion, as well, and also some select paying dividend growth companies in the U.S. and abroad.
That's my only real difference with what Sebastian has said. My only difference, really, because I think what he said is absolutely true, is that when he mentioned dividend growth, you see, I think that's searching for yield and dividend. And I personally believe capital preservation was important this year. It's going to be really important next year. And I mean, you look at some of these really wise, well-run economies, at least at the moment, communist-run free enterprise system in China. They're not only the largest gold producer in the world, but now they're the largest buyers of gold. There must be a message in there somewhere.
Well, I would agree with that. You don't search for yield. That's not necessarily what I meant. Is that a lot of people are doing that. They did that in 2007. Look what happened. So you got to be very careful with whatever you buy. You have to have an exit strategy. The income is fine, but when you buy a stock that has a 10% yield, and the stock goes from 50 to 25, who cares that you had a 10% yield, right? So searching for yield is the last thing you want to do. That's what happened during 2007 in the subprime crisis, and look at what happened. So you just have to buy good investments. Don't search for yield. Just have a competitive yield as part of your portfolio, and then ladder that with some more opportunistic investments, such as more commodities and things like that.
We always love having you on the show. Thank you, gentlemen. Appreciate your time. John Browne, Sebastian Leburn, thank you so much. Also, thank you to Jen Amos, Brian Rich, and Amber Dakar, as well as Mike Larson. As always, if you have questions for any of this week's guests or suggestions for topics that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Next week, we're getting into the holiday spirit with presents from the Weiss Research editors. We're not talking about stocking stuffers, but rather investment ideas, gifts that will keep on giving all year long. I'm Jamie Holmes for Money and Markets, and now, Martin Weiss.